Good day, everyone. My name is Daniel Lamfumar, and I'm one of the reporters in this chapter. So, this chapter covered two major topics: the planning and working capital management. The first section in this chapter is about the importance of planning to the success of an organization, how planning is done, and why planning should be quantified. The second section in this chapter, on the other hand, talked about the working capital management, its composition, and its relevance to the day-to-day operations of a company. So now, let's proceed to the proper discussion.
Hi everyone, my name is Danica Maydaga and I will discuss about planning and working capital management. So what is planning? Planning is very much related to another management function, controlling. These two management functions reinforce each other and both are very important for the success of an organization. Management planning is about setting the goals of the organization and identifying ways to achieve them. These may be broken down into the long-term plans and short-term plans. Long-term plans are reflected in a company's business strategy. In the process of planning, resources have to be identified. These resources include manpower resources, production capacity, and financial resources. Once a plan is set, it has to be quantified. A plan that is not quantified is useless because there will be no basis for monitoring performance and hence no way of gauging success. Quantified plans are in the form of budgets and projected financial statements. These budgets and projected financial statements are then compared with the actual performance. The actual performance, this is where the controlling function comes into play. It does not mean that if the actual performance falls short of the budgets or of the projections, the management is not doing its function. Reasons have to be identified for the shortfall so that corrective measures can be made. Also, the analysis will show whether the reasons for not meeting the projections are due to management incompetence or factors outside its control. So, we have the steps in planning. The first steps of planning is to set goals or objectives. The goals of a company can be divided into short-term, medium-term, and long-term goals. Short-term goals can be for a year, medium-term goals can be between 1 to 2, 3 years, and long-term goals can be 5, 10 years, or even longer. Management can actually define their time frames if short-term, medium-term, and long-term goals. Long-term and medium-term plans are generally established during strategic planning where the vision and mission of a company are revisited. Strategic planning sessions or workshops are not necessarily conducted every year. Vision describes what top managers want their company to become, which mission describe how the company will achieve its vision and makes the purpose and objectives of the company clear.
So the third step in planning is identify good related task. Identifying good related task to achieve an objective, it is involved in determining the specific actions or steps that needed to be taken in order to reach a desired goal. For example, a company has set a goal to increase sales by 15% in the current year. To achieve this, the management needs to identify relevant tasks. One possible task is to hire more sales agents if the current number is not enough to support the sales increase. This task focuses on expanding the sales team to handle the expected growth in customer demands. Alternatively, if the current number of sales agents is sufficient but their selling skills need an improvement, the task at hand would involve providing training programs to enhance their skills. By investing in their professional development, the company aims to empower the sales team to effectively generate higher sales figures. So the fourth step in planning is establish responsibility centers for accountability and timeline. So, establishing responsibility centers is important for accountability and ensuring that tasks are assigned to the appropriate department or individuals. Um, in order to achieve a 15% increase in sales, it is important for a company to recognize that various departments play a role in reaching this goal. While the sales and marketing department may seem solely responsible, other departments also contribute to its accomplishment. The production department, for instance, is responsible for ensuring an adequate supply of high-quality products. If if they fail to deliver defect-free items, the sales and marketing department will face challenges in effectively selling them. So, efficiency in the credit committee is also crucial. This department approves credit terms for customers and needs to evaluate applications promptly. This efficiency enables smooth sales transactions, allowing the allowing the sales team to close deals effectively. Aside from identifying the responsible departments, establishing a timeline for activities is essential, especially when tasks involve hiring additional agents. For example, if hiring more sales agents is necessary to achieve the sales goal, setting a specific timeline for the recruitment process is crucial. This ensures that new agents can be onboarded quickly to support the sales efforts and meet the goal within the desired time frame. So the fifth steps in planning is establish an evaluation system for monitoring and controlling. So this means that establishing an evaluation system is vital for effectively monitoring and controlling plans within an organization, because the system enables management to track the progress of their plans and make necessary adjustments. One common approach is to use quantified plans such as budgets and projected financial statement as a means of evaluation. Let's consider an example of a retail company which is planning to expand its operations by opening 5 new stores within a year. To effectively monitor and control this expansion, the management creates a budget that outlines the expected cost and revenues for each store. This budget acts as a measurable plan, serving as a benchmark for evaluation. Throughout the year, the company continuously compares the actual financial performance of the new stores within the projected figures in the budget. By regularly reviewing the financial statements and comparing them to the budgeted amounts, the management can identify any discrepancies or deviations from the original plan. If the actual cost exceeded the budget or if the projected revenues are not being met, the evaluation system allows for timely adjustments to be made to address these issues. So next is the last steps in planning. Determine contingency plans. Determining contingency plans is a crucial aspect of effective planning. Contingencies are alternative strategies that organizations prepare in anticipation of unforeseen events or situations that may deviate from the initial assumptions or expectations. By having contingency plans in place, management can mitigate the adverse effects on the company if the original assumptions do not materialize. Um, let's consider an example of a software development company which is they are preparing to launch a new product within a specific time frame and budget. While assuming a smooth development process, they acknowledge the possibility of unexpected technical challenges or delays that could jeopardize the product's timely release. To mitigate the risk, the company has devised a contingency plan. They have identified a backup team of skilled developers who can step in if necessary. Moreover, the plan includes a revised timeline that accommodates potential delays, enabling the company to adjust their launch strategy accordingly. So, through proactive consideration of contingencies, the company ensures preparedness for unforeseen circumstances. This minimizes the negative impact on the project's timeline, budget, and ultimately the company's reputation and customer satisfaction. Contingency plans are not limited to technical challenges alone. They can encompass various scenarios. So contingency plans are not limited to technical challenges alone. They can encompass various scenarios such as supply chain disruptions, market condition changes, or unexpected regulatory shifts. By anticipating and preparing for these contingencies, organizations can respond swiftly and effectively, thereby reducing risk and maintaining business continuity.
Hello everyone, I am Mina Marian and I will discuss the topic all about sales budget. So sales budget is the most important financial statement account in forecasting sales. In preparing sales budget, external and internal factors have to be considered. Sales budget is a financial plan that estimates the company total revenue in a specific time period. It focuses on two things: the number of products sold at the price at which they are sold to predict how the company will perform. They have two examples of sales budget. The first is the monthly sales budget. Monthly sales budget, as expected, similar and smaller than the quarterly budget. The second is the annual sales budget. Annual sales budget is much larger because it needs to evaluate each product over a longer period of time, and also include in sales budget therefore the income statement, balance sheet, and cash flow statement.
So now let's talk about the production budget. So production budget is a schedule which provides information regarding the number of units that should be produced over a given accounting period based on expected sales and targeted level of ending inventories. So in a business, they use production budget to estimate how many units they will need to produce in future periods based on the future estimated sales numbers. So we can say that production budget is very important. It is because production budget ensures that a company has the right amount of inventory in hand to meet customer demand. It also helps to avoid overproduction, which can lead to waste resources and excess inventory costs. And to find the required production in units, you just have to add expected sales and target ending inventories and deduct the beginning inventories. So for the purpose of this chapter, the financial statement method will be used in projecting financial statement. So based on this approach, the following steps will be followed. The first step is to forecast sales. In making financial projections, always start with a statement of profit or loss, and the most important account to forecast first is sales. Second, forecast cost of sales and operating expenses. For the cost of sales, the average cost of sales over the historical data analyzed can be used. If there are plans to improve cost efficiency, then such improved cost efficiency can also be considered. For example, if the average cost of sales for the past 5 years is 60%, but the management feels that given their plans to improve production efficiency, cost of sales can be reduced to 58%. In the projection, this 58% cost of sales percentage can be used. For the operating expenses, try to figure out which are variable and which are fixed. Variable operating expenses including commissions. Fixed operating expenses, on the other hand, include depreciation of office building, salaries, and some maintenance expenses. Third is to forecast net income and retained earnings. To forecast net income, there should be information on income taxes and how much financing costs the company will have. Financing costs will be based on the amount of loans the company has and the payment terms for these loans. There should also be assumptions on the interest rates for the projection period.
So hello to everyone, I am Ruth Angelica Pajares, and here are the other steps. So step 4, Determine balance sheet items that will vary with sales or whose balances will be highly correlated with sales. So balance sheet items that may vary with sales or will be highly correlated with sales are cash, accounts receivable, inventories, accounts payable, and accrued expenses payable. So step 5. Determine payment schedule for loans. The payment schedule for loans can be based on the disclosures provided in the notes to financial statements or the plans of management on how to pay the loans if no details about payment terms are provided in the notes to financial statements. So we have the step 6. Determine external funds needed or the EFN. This amount is more of a balancing figure or a squeeze figure. The balance sheet has to balance. So therefore, after assumptions are made to project different balance sheet accounts, the projected statement of financial position has to balance. So the formula for this EFN or the external funds needed is change in total assets minus change in total liabilities plus total change in stockholders' equity. So if the EFN or the external funds needed is put on the liabilities and stockholders' equity section and the amount is positive, this means that there will be additional financing. However, if the amount is negative, this means that there will be excess cash. Both negative and positive balances can be disposed later on by management. They do not have to be resolved on the first iteration of the projected statement of financial position.
And the last step in projected financial statement is to determine how external funds needed will be financed. External funds needed is computed. The management decide how to finance it. It can all be through debt or equity or a combination of debt and equity. Before the end of 2014, the president of JSC Foods Corporation had instructed the vice president for the finance to prepare the 2015 projected financial statement based on their most recent planning workshop. Based on the result of the planning workshop, the following assumptions were prepared for the 2015 projected financial statements. So sales are expected to increase by 10% in 2015 from 2014 sales level. This growth assumption is based on the assessment of the external and internal factors related to JSC Foods Corporation and historical growth of the company. The company's sales grew by 10.4% and annually from 2010 to 2014. The following financial statement accounts are expected to vary with sales based on the 2014 financial statements. 1. Cost of sales. 2. Cash. 3. Trade accounts receivable. 4. Inventories. 5. Other current assets. 6. Trade accounts payable. As of December 31, 2014, there are two long-term loans. Both have annual interest rate of 8%. The first loan will mature on June 30, 2015, and the remaining principal balance to be paid on June 30, 2015 is 1,250,000 pesos. The second loan amounting to 3 million pesos, which was incurred on December 31, 2014, is paid at the rate of 500 pesos principal balance every June 30 and December 31. New loans of 3,500,000 will be incurred on December 31, 2015, payable at the rate of 500 pesos every June 30 and December 31. Annual interest rate is expected at 8%. Other non-current assets and other current liabilities will remain unchanged. Income tax rate is 30% of the income before taxes. 75% of the income tax expense will be paid in 2015, while the balance will be paid in 2016. Cash dividends of 2 million pesos will be paid for 2015. So, in table 3.2 to 3.4 are the projected financial statement of JSC Foods Corporation in 2015. The next table shows the projected statement of financial position for 2015.
Greetings. My name is Melvin Ayuban and I am here to report about working capital financing policies, its definition, and its types. First, we have to talk about its definition. In simple terms, working capital financing policies is the capital or the money that the company uses for its day-to-day basis, like for its salary for the employees and expenses for the company, small expenses, and to make you have a better idea about it, um, I will give an example. Let's say a company has a 50 million sales, and it is functioning properly with a 10 million working capital. So if that company ever goes up like 100 million sales, then that 10 million will not be enough to cover the expenses of the working capital. So that means it has to provide more, allocate more money to the working capital so that it functions properly and it doesn't have any complications in the company. Now, there are three types of working capital financing policies. First is the maturity matching working capital financing policy. Second is the aggressive working capital financing policy. And the last type is the conservative working capital financing policies. And we'll be talking about that each and every one uh, in just a second. Now, the first type of working capital financing policies is called maturity matching capital financing policy. This policy states that the permanent working capital finance should be financed by long-term sources, while temporary working capital should be financed by short-term sources. Um, this permanent working capital is like the this is what like the most this is like what you use or what you permanently use. It doesn't change, so it always stays the same no matter. There's called a in a business there's called a peak season and there is a like the low season, where in peak season there is like the sales is up, so it depends on your in your product or what service you use. So in the peak season, the temporary capital financing is used because uh in that temporary we will be, let's say it's peak season, so the sales will go up and we will be using more capital for the working we will be using more working capital. So that's why we will use the short-term sources like loans in the bank, because it is not permanent. It will change and it will go down in some way. So let's say you live in a place where there's winter and you offer a service or a product that is only usable at winter. So your peak season will be in a winter season. So that's why in the temporary working capital, we will be using the short term, or in this policy, in this type of working capital financing policy, we'll be using short term for the short-term sources for the temporary, so because it will be paid by the end of the peak season of your company, while the permanent will be using the long-term, such as stocks or bonds, because it's permanent, it doesn't change, it's just like that, so it will get paid by those long-term in time. So next is the uh, aggressive aggressive working capital financing policy. So we move on to the next type of working capital financing policy, and it's called the aggressive working capital financing policy. In this type, even the maturity matching uses so it's the permanent working capital and the temporary is just its separate thing. In in aggressive working capital financing policy, the the permanent working capital requirements are financed by short-term sources like loaning in a bank. So in this, by using this, the by using the short-term sources, the company boosts its net income. And although this is a high risk high reward kind of thing, but it boosts the net income of the company. That's why it uses the short term, so that the financing cost is reduced. So we will move on to the last type, and it's called the conservative working capital financing policy. So the last type of the working capital financing policy is called the conservative working capital financing policy. In this policy, or in this type, if the aggressive if the aggressive type um, uses some of the short-term sources to finance the permanent working capital requirements, in conservative, the temporary working capital financed by is financed by or some of the temporary working capital financing is financed by the long-term sources like stocks. So some companies adopt this kind of type because it's not clearly clearly stated, but in studies, maybe it is because they do not want to be stressed about the temporary working capital. That's why they use the long-term sources, so that it will be ready. It will be ready in advance. They will just need to pull it out from their bank or anywhere, their wallets. So that's why they use this. So that is all, the three types and the definition of the working capital financing policy. We will move on to the cash by Nathaniel Cabigayan.
Good day, everyone. So we are here to discuss about cash. What is cash? The most liquid asset of the company, but it is also asset most variable. So, ang cash, pinaka-importante hiya aton company. So, kung for example, may ka company, need mo hin cash before ka magtindog hin company kay para may mo gagamiton pag tindog hit na business. So here is the following material control over cash unsuggested. So supporting cashiering functions from the recording and accounting function. So ang supporting cashiering function amot luwat hiya ang nagsusuporthan imo kanang business. Amot hiya ang kanang accounting function. So kung waray kahiton, di ka makaghimo him business issue. So on the second luwat, the issue official recipient for collections and summarizing collections daily collection report. So for example, kung may kuan nangutang ha imo han imo company. So pag nagbayad diya, kailangan mo na pag nagbayad na harantanan, like sorry ton, igmo nagkukuan kun pera nimo na collection han mga pinaagihan imo report. So ang deposit collection liwat amot hiyaan, like for example, pares lagay pa na issue number han ikaduha. Then hiya ito ang deposit and collection. Hiyaan bukan kung nagbayad na imo, ban imo kikintahon. Then ang fourth luwat, adopting the check voucher system for payment. So ang voucher liwat, like kung hataas ang interest, mas mapapahabubo mo hiya amo niya gamithan voucher system payment. So thank you.
Moving on, in if a company wants to estimate or want to know how much money they will be using in this accounting period, let's say, then they will prepare what's called a cash budget. A cash budget shows how much money is estimated that they will be using in this accounting period. So a cash budget can be used or can be made monthly or quarterly. So in a cash budget, there are different there are different parts of this cash budget. First, we have the cash receipts. Next is the cash disbursement, net cash flow for the period, target cash balance, and cumulative excess cash. So we will be talking about that one by one in the next slide. So now let's go to the parts of the cash budget. The first part of the cash budget is the cash receipts. So this includes the collections from receivables, proceeds from banks, issuance of new shares of stocks, and advances from stockholders. Next is the cash disbursements. Uh, Cash disbursements include payments from suppliers or other service providers, payments for loans, and cash dividends. The third part of the cash budget is the net cash flow for the period. You can get this by subtracting cash disbursements to the collection of the period, and this in turn we will get the excess cash or the cash deficit of the period. Next is the target cash balance. So the target cash balance, this shows that, or this states the amount of money that the company needs to maintain in order to have a safe, or in order to have a balanced functioning company. So in target cash balance, this is where they tell, or they look at the needed cash to have in their bank or in their wallets in their company to have a functioning company. Next is the cumulative excess cash. So this is the most important part of the cash budget, and the last part. This is where it shows the estimated cash that will be used in the period, in this period. So that is all the parts of the cash budget and what is a cash budget.
Hi everyone, I'm Kim Limpiado and I'll discuss the primary and secondary reasons for holding cash. The example for primary reasons is paying rent or buying groceries, etc. The example of secondary reasons may be speculative, means speculating in share market, etc. One more example of holding cash is a precaution measure for future. The primary reasons of holding cash are for transaction and compensating balance purposes. In order to avail the convenience of holding a current account, the minimum cash balance must be maintained by the firm, and this provides the compensation. The secondary reasons for holding cash are for precautionary and speculative purposes. The primary reasons for holding cash are the reasons or the things or which the person spend firstly, but the second reasons for holding cash are the reasons or things which not first preferable.